when the crash of 2008 and early through the first quarter of 2009, we went on the offensive. And one of the presentations we put together, which is timeless, is called After the Crash. And what we did in that presentation is to help educate people about how the markets really work. And we quoted Benjamin Graham: investors who have either the enterprise or the money to invest now somewhere near the bottom are likely to prevail over those who wait for the bottom and miss it. Market crashes from a historical perspective. First of all, we want to tell people market crashes have always been with us. Since 1928, there have been 87 market drops of 10% or more compared to 23 market crashes of 20% or more. So we know that markets are volatile. As a matter of fact, volatility, everyone always says they hate volatility when it comes to the market, but that's not true. They just don't like the downside volatility. And the returns come from the upside volatility. But you can't get the upside returns unless you're in there long term, and it can take both. Since 1946, it's only taken 111 days on average, trading days, to get to the pre-level crash level. And the reason that stocks historically provide such a premium over fixed income is because they are volatile. If they weren't volatile, there wouldn't be a premium. No one would own them. Theoretically, it's a cost of capital story. No one's going to own something long term if they can't have a higher expected return. Without the volatility, if there was someone that could properly tell you when to get in and out of stocks and leverage it, then what would happen is the market volatility would go away and you just have a steady increase. You'd have, in essence, you'd have a CD. So what we did is we went back through history and we said, okay, what if you had built, and this isn't even a 100% equity portfolio. We looked at our total clients' holdings and we found that the average portfolio had about 70% equities and 30% fixed income. And in this graph, what we're doing is we're focusing only on the US portions because we don't have data going back long enough. We'd love to have data going back to 1926 internationally, but we only have it from 26 in the US market. So we're going back trying to get in as many crashes as we possibly can. And what we're showing here is 15% in T-bills, 15% in 5-year government, 10% US large, 10% US small, 11% microcap, 22% US large value, and 17% US small value. So we have a great mix of assets here, diversified, thousands of different equities. And what we're going to do is we're going to go back and we're going to look at every crash that we can, going back to the first crash here, February 2001, February 2003. It was a 22-month crash. The total S&P dropped 36% during that time period. You saw things like this time looking beyond the bear. Yes, it's scary out there. I love the cell phone. We haven't had cell phones like that in forever. This is kind of like that Tice guy, really, the bear with the business suit.
With the business suit.
Don't you think? This is Tice right here.
Yeah.
Yes.
Maybe he's a prudent bear.
And he's wearing very comfy shoes. They're serious, but they're comfortable. So fear of the free fall in the market. U.S. World Report says most Americans have lost faith in stocks. No duh. But still, if you owned a diversified portfolio even with 30% fixed income, you can see, yes, from that crash going forward during this 5-year period of time, if you look at consumer price index and 1-month T-bills, that you still historically did quite well. As a matter of fact, 1 year out, you had 43%. 3 years out, a compound return of 20%. And 5 years out, a compound rate of return, even with that big dip in there, of 12.89%. After the crash. We'll go back to 1987, September to October, 2-month period of time, the S&P crashes 23%. And these are all the asset categories that people in the Prudent Bear Fund are trying to avoid, right? They're trying to find some way to get around this. Well, the best way to get around that is having some of the money in fixed income, so when the market goes down, you can rebalance your portfolio and have someone do that for you automatically, buying things when they're down. Time ran the crash. After a wild week on Wall Street, the world is different, i.e., it's never coming back. Technically, the crash of 1987 bears an uncanny resemblance to the crash of 1929, says George Soros. What do you expect us to do? Announce that the cabinet members will be buying IBM and General Motors? No, that wouldn't happen until the 2000s. And Lee Iacocca says the borrowing has to stop. But if we carry this out from the period of the crash, if you had stayed in, the 1-year rate of return, 18%, 3-year rate of return 6%, 5-year 12%, 10-year 14%, and 20-year 11.8%, when everyone was predicting that the world was different and it was never going to come back. See, every time we go through these crashes, we hear the same things over and over. 73, 74. This was, ironically, when my father first got in the business, doing mutual funds and equities. This was a 21-month period. The S&P tanked 42% during that period of time. In fact, Time ran this, the economy. Obviously, it's sick, it's a big headache. The U.S. banking system has stretched very much to its limit. Now even nations are in danger of default. This is Business Week.
74, 75, or 2010?
We heard this. Yeah, we heard this yesterday.
Yeah.
On Larry Kudlow. Holding the segment. And I intoned this has happened before, but they didn't want to hear that. The worldwide threat of financial instability rises, says Business Week. The slide is deep with no end in sight, says Business Week. And yet, if you held a diversified portfolio, rebalanced and stayed disciplined, $1 during this period of time over the next 20 years grows to over $20. 1 year out, 35%. 3 years out, 26%. 5 years out, 23%. 10 years, 20%. And 20 years, 16%. November 69 to 70, 7 months. Total S&P return, negative 19%. Here we have Time. Money chief author Burns facing an economy on the brink. There's always the doom and gloomers. Always the doom and gloomers. For automakers, 1970 was the toughest year in at least a decade. Buyers spurned big models in favor of less profitable compacts, mini cars, and fast increasing imports. Unemployment rose from 3.9 to 5.8 in November, the highest in 7 years. Well, I wish we could get back to 7% this year. That'd be nice. Or 5.8%. That'd be nice. 7 would be nice too for this year. And yet, if you look at the rates of returns of investments during this whole period of time, $1 goes to over $14, 33% in 1 year out from the crash, 8%, 7%, 12%, and 20 years out, 13.8% for that diversified holding of equities and fixed income. March 62 to October, 8 months. The S&P, negative 17%. Check out Times Magazine's cover. Terrible artwork back then.
The Bears beating the Bull.
Huh?
The Bears beating the Bull.
62, the year before I was born. There, behind its gray stone walls and Corinthian columns, the New York Stock Exchange was shuddering through its worst since 1950. The hectic week, the paper volume of 1,500 stocks on the big board fell $30 billion, which is more than the GNP of Australia, Sweden, and Ireland. That's not even a good bailout anymore. 30 billion, come on. We throw that at a bad road project. 62 to 82, 26%, 18%, 17, 11, and 12. If we look at the growth of $1 goes to over $11 during that time period. 46 to 47, 11-month crash, negative 20%. And here, this is all we can find. This little teeny thing here. Some see bear market, illiquidity of equities to keep up upward course Washington situations in the New York Times. The unit volume of retail sales went down an estimated 10% during 1947. It's far too late in the fight against inflation to place our main reliance on voluntary action, says Harry Truman. But if you look at the market, going from $1 from 1947 to 1967, $1 goes to $11. We have 13% 1 year, 10%, 5 years, 12%, 10 years, 13%, and 20 years out at 12%. The crash, the big one, the mother lode, the disaster, 1929 and 1932, 34 months, over almost 3 years of bad performance. Total S&P 500 return negative 83%. You ready? Wall Street routed. The country is not in good condition, says Calvin Coolidge. Really?
Understatement.
Really?
Sometimes you just got to say
State
it.
the obvious.
Understatement of the year. Wall Street in panic as stocks crash. I mean, you had people jumping from the roofs and from the windows in Wall Street. Wall Street lays an egg, quips Variety newspaper. All those artsy-fartsy people are always, quipping poetically. Wave after wave of selling again moved down prices of the stock exchange. This is when I do my Captain Kirk imitation. Wave of selling again moved down prices of the stock exchange. Billions of dollars clipped from values, says the Minnesota Star. So obviously it's the end of equities. It's never going to come back, Zach, ever.
If it was never going to come back, that would have been the time, probably.
Throw in some world wars, if things weren't bad enough. Destroy about 3/4 of the industrial production of the whole planet. What happens? 1 year later, 257%. Now you have remembered the microcap story of the microcap segment of this was what?
Up 400%.
Up 400% in 1 year. Just when you thought it was really truly Armageddon. We think that returns and the challenges that we face today are tough. They were nothing like, and people say, oh, well, this is like the Great Depression. We've seen nothing compared to the Great Depression. And still, the market once it finally come back, it rages back. And the point here is that historically is that markets go up faster than anybody can possibly imagine, and against anyone's hopes, against anybody's fears, no one predicts it. And you see stuff like this. 3-year rate of return, 46% per year. 5-year rate of return, 43% a year. 10-year rate of return, 17% a year. And 20-year rate of return, 17.76% per year, coming out of the Great Depression.
What makes me laugh every time I look at this slide is that 3-year number. It's 46%. The
Looks
bar
tiny.
looks so tiny because that 243% bar is so big.
Yeah, 46% never looks so small.
Yeah.
What if you locked in your losses? If you were in December 8th, 2008, when the S&P index was dropped 38%, this is the last crash. The U.S. government treasury bills were only paying 0.005%. How long would it have taken you to recoup your losses? Almost 2,300 years if you locked in your losses in T-bills at that time. But in all cases, historically, if you stayed long-term, these are the lessons that we have learned. Long-term, there always is a recovery. Every single time. There has never been a war, a recession, a depression, any set of human events that have not caused eventually the market to go back up. So there always is a recovery. No one can tell you the exact date of the recovery, how fast the recovery will be, but the market historically always recovers. Exact market bottoms are impossible to predict. So don't try. You or anyone else that you could possibly turn to does not know. Do not know. And if they did, they wouldn't tell you. The next 100% move is always up. There has never been, for a diversified portfolio of this proportion, a 100% move down. As a matter of fact, for that to happen, thousands and thousands and thousands of stocks would have to go bankrupt simultaneously in the U.S. market, which would pretty much be Armageddon. It wouldn't matter where you had your money. And if stocks don't work, if capitalism doesn't work, think about it for a second. Thousands of entrepreneurs, thousands of companies all over the United States creating wealth. If that doesn't work, you can forget about your money in CDs. You can forget about the money at the bank. You can forget about the money at the federal government, because if that doesn't work, those are the engines that drive all these other divisions. The federal government cannot make it unless business works. Market recoveries historically are fast and furious. You can't wait on the sideline and go until, I'm going to get back in when it's really clear that they're going up, when I really know it's safe. Remember that movie, The Marathon Man, who says, is it safe? Is it safe? It's never 100% safe. That's why there's premiums. And the largest single recovery followed the largest single crash. The historical returns, and so therefore the highest historical returns follow a crash. While we don't think that Warren Buffett is brilliant and can pick all the best stocks in advance, we do believe when he says, as others do, that it's the people that keep their heads and buy more in the crash, in the market downturns, that eventually end up maximizing their wealth. There are more millionaires made in the Great Depression and in different recessions, whether it's real estate, whether it's starting their own businesses, whether it's allocating their portfolios to cash. That is the time that long-term millionaires are often made. And we go back to Benjamin Graham. Investors who have either the enterprise or the money to invest now somewhere near the bottom are likely to prevail over those who wait for the bottom and miss it. Historically, every market has recovered its losses. And we're still not, the S&P and the Dow still aren't back to their levels of where they were in the 2008, before the 2008 crash took place. So if history follows, eventually they will be. It'll be those investors that sold during the bottom and don't get re-engaged until it goes back up to its all-time highs that will eventually lose and panic when it drops again. And so the pattern continues. Great lesson here after the crash if you're an investor and an advisor.